When NVIDIA reported its fourth quarter earnings on February 26th, global markets weren't just watching the quarterly numbers. They were looking for clues on whether the AI infrastructure investment wave still had legs. NVIDIA delivered quarterly revenue hit $68.1 billion, up 73% year over year. Data center revenue reached $51.3 billion, up 93%. Gross margins expanded to 75%. The numbers didn't just set records, they confirmed in hard data that the AI supercycle hasn't peaked. CEO Jensen Huang's blunt "the market is wrong" comment, combined with a simultaneous bounce in software stocks, signaled that the logic of who captures value in the AI food chain is undergoing a fundamental shift. NVIDIA posted multiple historic milestones in the fourth quarter of fiscal 2026. Quarterly revenue rose 14% sequentially, the largest sequential gain in company history. Data center revenue hit $51.3 billion, with compute revenue more than tripling year over year and networking products doubling on the back of related technologies. Full-year revenue reached $215.9 billion, up 65%, while net margins stayed above 55%, an absurdly high level. Its Blackwell architecture chips continue to ramp, supply constraints remain, but customer orders are already lined up for several quarters ahead. Management's earnings commentary emphasized sovereign AI and inference demand, a clear signal that AI capital spending is spreading beyond North American hyperscalers to global enterprises and governments. The demand map is getting bigger. Beneath the headline numbers, three structural shifts are underway. First, pricing power in the hardware supply chain is now permanently locked in. NVIDIA's 75% gross margin, combined with the fact that 6-year-old architectures still sell out, proves that AI compute supply is structurally tight. This crushes the old narrative that more competition inevitably means lower margins. Huang flatly stated that NVIDIA offers the highest performance and the lowest per token inference cost globally, a declaration that its AI infrastructure monopoly won't be broken anytime soon. CoWoS packaging, now standard for high-end AI chips, has become a capacity bottleneck and a barrier to entry. NVIDIA has locked up 60% of global CoWoS capacity for 2026, further cementing its lead. Second, the panic in software stocks is being walked back. Before the earnings release, several SaaS giants cratered on fears that AI agents would render them obsolete. But Huang pushed back explicitly. No one serves those customers better than the platforms themselves, he argued. AI, he stressed, enhances the existing software ecosystem. It doesn't simply blow it up. Following the report, a key software ETF bounced 3%, a sign that markets are redrawing the line. Tool-based software gets disrupted. Platform-based ecosystems get amplified. Third, the sustainability of the CapEx cycle is confirmed. There's been plenty of chatter questioning hyperscalers' ROI on AI spending, but NVIDIA's 93% year-over-year data center growth tells you that real demand still exceeds supply, by a lot. In a seller's market like this, global hyperscale AI infrastructure investment isn't just holding up in 2026, it's likely to accelerate as new chips come online. This NVIDIA report marks a turning point. The AI investment theme is officially moving from narrative-driven to cash flow validated. Markets are no longer paying a premium purely for distant stories. They're buying today's supply shortages, today's monopoly pricing power, and today's high-growth certainty. With NVIDIA generating $43 billion in operating cash flow in a single quarter, up 94% year over year, its valuation logic has shifted from hyper-growth story to rare asset that's both a growth engine and a cash cow. For investors, three takeaways stand out. 1. Overweight the AI hardware infrastructure chain. In NVIDIA's supply chain, CoWoS packaging, HBM memory, liquid cooling, capacity constraints are stickier than chip design itself, and opportunities remain clear. 2. Selective bottom fishing in software. Focus on AI-enhanced platforms. Companies with deep workflow integration and proprietary data assets have room for valuation repair. Pure-play automation tools face longer-term replacement pressure. 3. Watch for the supply-demand inflection in late 2026. track chip capacity ramps and cloud capex growth closely. When bottlenecks ease, hardware multiples could face a temporary repricing risk.